Hello, everyone. My name is William Mucker. I am a client executive with Camaplan, and I would like to thank you all for joining us for today's webinar, Investing in Energy as if it were real estate, with Charles Sales and Eric with King Operating. As a quick note, please be aware that Charles and Eric will be answering questions at the end of the presentation. However, feel free to use the chat and/or Q&A function on your screen to pose your question whenever they cross your mind. They will be saved and addressed once the presentation portion ends and the Q&A portion begins. Before we get started, we do have a brief disclosure to go through. Everything presented in today's webinar is strictly for educational purposes. Camaplan is a neutral third-party administrator of IRAs. We are not attorneys, CPAs, or financial advisors. If it comes to a time where you need advice in any one of those fields, we highly recommend you consult with your team of professionals. We are more than happy to be a part of the dialogue with your team of professionals to make sure the investment process is quick and seamless. We do not sell any investments at Camaplan, nor do we endorse any products. We will never call you about the next best investment opportunity. We believe that you should always do your own due diligence before investing your money, whether it be retirement funds or otherwise. Once you have found the investment that is right for you, we will help you open your account, fund that account, and facilitate the transaction into that investment. Here is my contact information if you or anyone that you know who you believe can benefit from the information have any questions about what is discussed in the presentation today and how it applies to self-direction. Please do not hesitate to contact me. I'll be more than happy to help. And without further ado, I'll pass the controls over to you, Eric.
Sounds good. Thank you so much. Let me go ahead and get my screen share up and running here.
Perfect.
Okay. Make sure this is showing the right thing. Good.
Looks good.
All right, we'll get started on the full view. All right, you see the full view?
I'm seeing the presenter's view. I think you need to switch screens.
Yeah. Normally we get this done ahead of time. Sorry, folks.
It happens. It's that time of year. All right, looks good.
There we go. All right. Well, yes, yeah. Thank you for having us here today. Our purpose here is to walk you through our business model, what we're doing, quick updates, a little bit about our history and things like that. I don't want to take too much more than maybe about 20-25 minutes going through this. And I know most people are new to oil and gas, so I'm going to be very educational and kind of line item walking through and marching through exactly what we are. But we are an American energy producer here in Texas. We've been around for 26 years here at King Operating, and we are fully a domestic company. We drill American oil and American soil. And of course, we have our disclaimers as well. So please feel free at any time, if you're interested in this, you can reach out to any of the guys there, or Cole or myself, and we'll go ahead and get you this information to review on your own. So I will walk through our strategy, our value, our depth of knowledge, our team, and a little bit about our track record as well. But we are in the middle of a $200 million raise for a tax-advantaged, income-producing, asset-secured fund here in the oil and gas space. And you'll find out through the course of this presentation, we're very similar to a multifamily or a commercial real estate fund. We don't have a 25 or 30-year horizon like most oil and gas companies. We're really looking more for a 3 to 5 year space to come in and develop land and flip it. And we are targeting on the high side of things. All stars align. I think we can get to about 1.3 billion on an exit of this fund. But I'll walk you through all the variables with that as well. So the first thing we're going to walk through is the overall strategy of the company, which is very, very important to understand. So on the left side, you'll see the investor benefits of coming into a fund like this. They're three-pronged. I was an investment advisor years and years ago, been an entrepreneur for years. I can't think of any other investment that has these three approaches, which is why I work here. And the first and foremost, right off the bat, since it is December 7th, Pearl Harbor Day, by the way, if a little bit of history. On December 31st at 11:59 is your last chance to wire in funds and reduce your taxes significantly, which is something we offer 100% write-off against AGI. We also offer monthly passive income, which I'll refer to as MPI. So when you hear MPI, it means monthly passive income. The third benefit that we provide to investors is unique to King. There are some people starting this now, but in 2015, we changed the model. Traditionally, oil and gas investments are very simple. And on the investor side, only about half of the slice of the pie. So traditional oil and gas investments are investing in a small piece of land, 3, sometimes 1 to 3, sometimes 5 well programs, where essentially you get a tax write-off and you get quarterly income for 25 or 30 years. while the oil and gas company owns the lease, which is the main profit center in oil and gas deals. So we actually offer ownership of the lease to our investors to make it an asset secured fund, and allowing you to participate in again, the largest revenue generator in these types of deals. Now, our primary function is three-pronged. So we have a very simple process and program we follow. We look for land, we acquire land, develop it, and divest. Very simple. So we're more on the flip side of things as opposed to the 25 to 30-year income plan. Now, once we've done our geology and gotten through our research to understand whether or not the land has hydrocarbons, which in today's world isn't really a gamble, the technology is pretty good. You really know what's there or not. The problem or the issue or the difficulty is, will engineering meet the hydrocarbon layout? So once we have a good idea of the hydrocarbons and a basic approach to the engineering that we think will be successful, we start acquiring leases, and then we start raising equity, which is why we're talking today. The purpose of raising the equity is not only to develop the land, it's also immediately to start drilling for what we call PDP, or proven developed and producing wells. It's a fancy way of saying revenue generating wells. So the more wells we have that generate revenue, the higher the value of the land, showing that the land will yield the hydrocarbons. Now, while we're drilling these PDP wells, we're also creating what are called PUDs. So these are locations that show significant hydrocarbon reserves underneath the surface, and we're just not drilling them yet. So what we do is prepare the surface. It's kind of like pouring a foundation for a building you haven't built yet. It does two things. It allows you to, number one, expand your operations immediately because you've done some of the hard work, or sell a program at a premium because you've saved somebody else on hard work. Now, the purpose of this process and this plan is to be able to raise the value of the land. So if we have a $200 million raise, our goal immediately would be to get to $400 million in land value. At that point in time, what we would do is open up our divestiture window and look for two different types of buyers and two different stages of the fund. So before I get into that, it's important to understand what our acquisition methodology is for land. So first and foremost, we're always looking to work in multiple basins. That helps us maximize the upside and minimize risk, or de-risk the program a bit. But we are always looking for 3 to 5 basins of focus, or BOF. We're looking for land that's adjacent to proven production. So we're not in the proven zone. Just to give you an idea for those of you who are new, proven areas with simple drilling are generally $20,000 to $30,000 per acre. We're looking for the land that's right next to it that we can prove up and transition it into new proven land. We're looking for attractive pay zone geology through our 3D seismic. This is very important to note. It's a big piece of the puzzle on acquisition, is understanding how an acquirer would think. They're going to look for affordable land with attractive pay zone. A pay zone is something that you can think of very simply. Imagine a stack of pancakes turned upside down. The plate would be the surface of the earth, and all the layers of rock below would be zones. The ones that have hydrocarbons in them allow us to get paid, so we simply call them pay zones. A very scientific term that we use. We're always looking for a minimum of 20 drilling locations in oil and gas friendly environments, primarily on privately owned or state-owned acreage. This allows us to stay out of the crosshairs of the federal government and their ability to restrict oil and gas on the stroke of a pen. We look for low cost, high control lease terms. A better way to think of it is held by production. What we look for is land that we can put a sliver of cash down on just to get the land and get access to it. And once we start producing oil on the land, we cut a deal with our landowners that as long as we're producing oil, the lease is ours in perpetuity. So that creates not only a good relationship between the landowner, it also creates a great relationship between an acquirer who would have a much longer and much stronger lease to purchase. And from time to time, we're looking to acquire proven developed and producing, or PDP, revenue generating land that already has wells on it. We just acquired a little piece recently to add to the overall monthly passive income. But we're always looking to stay close to our geography. So we don't want to have an operation in Wyoming and then all of a sudden get one in Pennsylvania. It's just too far away from where we are. We'd cannibalize ourselves. So we try to look for locations that are close to where we are for ease of transition of people, machinery, and equipment. And of course, we're looking for a good mix of oil and gas. They both have their own economies of scale, and they both feed totally different industries. So we look to be able to diversify our revenue generation as well. Now we have gone through much of the program here today. So we were looking to complete our 3rd well by July. We're actually on our 5th well now here at the end of the year, with 2 more being completed. We've completed an acquisition of our previous fund in June, which I'll go through in just a moment. And we began producing monthly passive income in August. So you're not going to have to wait too long for income. It's already here. Now, again, the primary purpose after we acquire leases, raise money, drill for PDP, get revenue and raise the value of the land through PUDs. The thing that we're looking to do is we're looking to, in 2 years after funding, we're looking to sell off a sliver of the program to an income buyer. So a family office, a pension, an endowment fund, somebody with an income mandate. We're looking to sell off, 35 to 40% of the fund at that point in time in order to do two things: rally up a little extra cash to finish the drilling program, and more importantly, to return capital back to our investors. From that point on, we continue to drill and develop. And at the end of the fund, we're looking to sell to another producer. So that's a mid-sized, large-sized, publicly traded oil and gas producer, or a private equity group, which is really, really on the rise right now. Private equity is buying a lot of oil and gas land. So in our current portfolio right now, we actually have 10 properties, 6 of which we're in due diligence right now to start selling in 2024. So we have a big sale coming up here in 6 days. So we'll be looking at dropping 6 of these properties and selling them in the market. Some will sell at a break even, some will sell just to get rid of expenses, some will sell for a profit. And profit is being sold and distributed back to investors through the fund, which is a great thing for all of you at this current point in time. But it's important to look at these things from an acquisition standpoint. So our Rhino project up in Wyoming in the Bighorn Basin, we have 52,000 contiguous acres. And contiguous is a big word in our industry. Those who are buying oil and gas land are not looking for checkerboard ownership. They're looking for contiguous acreage that they can work, for the next 10, 15 years. And 52,000 is a very large chunk of land. So a very, very attractive piece of land that we're developing right now. It's about 50-50 oil and gas. We've identified 4 pay zones, which is tremendous, with a 5th pay zone being possible in the spring. If all our stars align, we could get to $100 to $300 million divestiture from that piece of land. That's a few years out. So right now we're on a good path. But our biggest risk up there is seasonal drilling. So in Wyoming, it gets very cold, very snowy, and when the snow melts, very muddy. So we can really only drill in that area of Wyoming about 8.5 to 9 months out of the year. We've actually just shut down our winter operations, but that's pretty normal practice in that area of the world. Now, Denver is an interesting piece of the puzzle here. So the Denver-Julesburg Basin in Larimer County, Colorado, was actually a program that we purchased in 2018. In 2018, a couple of months after our purchase, the political environment switched from red to blue, became very, very regulatory, a lot of regulatory difficulties in that program. Once we finally ironed them out and understood what they were trying to achieve so that we could fit into the model, we then saw the 2020 COVID Black Swan pandemic, which pushed us back a little bit even further. During that time frame, we actually grandfathered that property into a new fund and surrounded with other properties. I'll go through that a little bit later. But during that time frame, they made it very, very difficult to drill for oil and gas, which we're actually drilling up there. We are pulling oil out of the ground as we speak. But the 3 surrounding counties all ran out of water. So during that time frame, they approached us because very few people know that when you drill for oil or gas, you will pull tens of thousands, if not hundreds of thousands of barrels of water out of the ground. And in oil and gas, for us, that's usually an expense center. We usually pay $1 or $2 per barrel to dispose of the water while we're drilling for oil. But in that area, we are now kind of flipping the tables there. We're structuring a deal with the municipalities to be able to sell them our water from the wells. So we need to build a relatively small speaking, water filtration plant up in that area. So although there is a divestiture possibility, this is really a revenue generating piece of land, and we're hoping for anywhere between 20 to 60 million. Of course, we don't know what the world will bring at that point in time, but right now we're targeting a 20 to 60 million dollar revenue source from that piece of land. Now in Cotton Valley in East Texas, we have 2,000 contiguous acres right next to a very large natural gas producer. So once this land is proven, no guarantee, but we have a buyer next door. So that stuff's very common with us. It's 100% focused on natural gas. There's one really large pay zone there. We actually drilled these 2 wells late last year, and the price of natural gas dropped from about $8.90 down to $2 for a really long period of time. So it wasn't economical, but we are now in the middle of completing our frac. So we are opening the wells there right now and expecting production to begin sometime later this month, which will begin paying our investors in February. So while we're doing that, we're looking at a revenue upside of about $7 to $15 million from those 2 wells. There's 4 other locations that are really prime for drilling there as well. But we may run through the revenue and drill a couple more wells on that piece of land, or we may complete these wells, show great production, and sell that piece of property for a profit soon. But we don't know what that holds until the frac is complete. The Believers Project in the Permian Basin here in Texas, if you're not familiar with the Permian Basin, it is really kind of the Yankee Stadium of oil and gas not just around the country, but around the world. Most people don't know that there's enough oil and gas between Texas and Alaska to power every vehicle, home, and manufacturing center on planet Earth for the next 600 years. There's a ton of reserves there. Now, in this very illustrious and prestigious piece of land, we have 22,000 plus contiguous acres, really focused on oil, and we've identified 6 different pay zones. Now, the kicker here from an acquisition standpoint is the fact that there's just one landowner and one mineral rights owner. So this is a very clean lease. We're already producing, so we're held by production already. And our biggest risk up there is really difficulty in drilling one of the pay zones. So one of our pay zones is called Mississippian Chert. It's very prosperous when you hit, but very difficult to drill through. We've already drilled one well that's going online as we speak. But we are possibly going to drill another one through the course of the well, but we have 6 other pay zones with much simpler drilling. So we're going to focus on spreading that through, proving those pay zones. And at the end of the day, we hope if we can prove the land out over time, we might be looking at a $400 million to $1 billion acquisition at the end. And these are just simply some maps of the acreage in the Permian and in Wyoming. So as you can see, they're contiguous acreage. We put these up here just to let you know that everything we're doing is completely verified and public knowledge through the Railroad Commission. You can look up and review any of our locations or our wells. So the value, so that's what we do on that side. That's our business model moving forward. It's really what we're focused on. The value is super important, obviously, to an investor. So what we're looking to do here is be able to offer you a 3-pronged approach. Number 1 being 100% tax write-off against just adjusted gross income. That is W-2, 1099, passive, active, state, local, federal. It's tax shielding from all of those different levels. So it's the adjusted gross income. So our average investor at $200,000 per unit is normally in a 40% tax bracket, seeing basically a $60,000 cash on cash return in year 1 just from tax savings. We are shooting for a 8 to 12% return. In the near future, prices are a little volatile as we speak, with a lot of geopolitical events and currency events all around the world. We are actually targeting 14 to 21% over the course of the lifespan of the fund. However, in the environment today, we want to be as cautious as possible at 8 to 12%. So on a $200,000 investment, that would be $1,300 to $2,000 per month. We are not there yet, but we are rapidly building up to that in Q1 of 2024. And of course, the final prong is the ROI, the exit value. So if all things go well, which I'll walk you through a sensitivity analysis to show you how we're thinking, we could be looking at a 3.5x return on a $200,000 investment, essentially turning $200,000 into $700,000 minus the tax benefit. We don't include that in the ROI over a period of 3 to 5 years. So the tax benefit itself is simple to understand, but I want to go through a little detail. So our tax benefit is driven by IRC code 263, which gives us that and a few other tax codes, give us a good rundown as to ways that we can spend money in a tax efficient manner. So your money doesn't sit with us for 6 to 12 months. You'll be lucky if the capital you invest isn't deployed into the ground within 6 weeks. We have a very strict spending schedule to lay out our entire drilling program over the course of the next couple of years. We try to do it as fast as possible and prepay, lock in our supply chain, and kind of avoid inflationary trends that we're seeing. So it makes us more profitable the faster we raise money. But we're very comfortable promoting a year 1 75% tax benefit. The remainder of your benefit will be spread across 4 years, years 2, 3, 4, and 5. But year 1 tax deduction factor at 75%. We've achieved that for the last 15 years. We're comfortable promoting that, despite the fact that last year our 2 funds had an 87.5 and a 90% year 1 deduction factor. But that was a really good year, and we certainly don't want to promise that and underdeliver. So again, year 1, a $200,000 investment at 75% would get you $150,000 removed from taxable income. And if you're lucky enough to be in the 40% tax bracket, if you're not in California or New York or New Jersey, it's generally about a $60,000 cash on cash savings day 1, year 1. However, if you're in California in particular, it looks more like 51%. So really large tax savings for those in high tax state tax environments. So it's important to understand from the business model perspective how the revenue works, how you get paid. When we pull oil out of the ground and sell a load, the first people who get paid are the royalty and mineral rights owners. They're always paid first, followed by the lease operators, or those who pull the oil out of the ground, leaving us with net profit. So 80% of our net profit is distributed to our investment partners throughout the course of the fund until capital is returned. So once your principal is returned and you're made whole on your investment, we switch to a 60-40 model all the way through divestiture. And again, some people say, why do you do that? Well, we're the only oil and gas company that offers even 1% of that profit center. So that is where we make the bulk of our money, is in the leasing. And since we have such a strong correlation to real estate, I always try to include some comps. These are a little older, but these types of deals literally happen 25 to 35 times a month in our industry. As you can see, Northern Oil bought 37% working interest of the Mascot project in Midland for $330 million in cash. Same type of deal we'd be looking to do with a family office or an endowment or a pension. And then, of course, the exit is a mid-size, large size, or publicly traded producer or working interest partner who would come in and buy the properties individually or as a compilation. But again, as I said, private equity is really big in our space right now. One of the bigger irony pieces of 2023 for me was realizing that the largest buyer in private equity of oil and gas space is BlackRock, who happens to be also the largest pusher of clean energy and ESG standards. So while they're telling you on TV to get green with your energy, they're buying oil fields behind the scenes. So we have done a sensitivity analysis to show you how we get to a 3.5x return. This is our base case, our management case. This is what we're trying to achieve. And of course, it's a difficult industry, so there's no guarantees that this will happen. However, in the next 3 to 5 years, we are shooting to get to 12,000 plus barrels of oil equivalent. That's oil and gas added together. And if that comes in at an $85 per barrel oil price and $5 MCF of natural gas, we would be looking at a 3.5x return. Now, of course, that doesn't mean that that'll be the case. So we've run through different scenarios you can view on your own with lower production, higher and lower pricing. But I always try to go to the low case scenario. So if we were only to get to 6,700 BOE over the course of the next 3 to 5 years and pricing was $60 for oil and $3 for gas, we'd be looking at a 1.5 multiple as opposed to a 3.5 multiple. So our production and market pricing have a lot to do with the overall return of the fund. So that is the horse, and these are the jockeys. So our team here, we've got a great team here. Jay Young, our CEO and founder, is a fourth generation oil man. He started this company 26 years ago. Jay has had oil and gas in his blood since he was a child. About 9 years old, he started helping his grandfather working on rigs and pumps in Texas. Grant Patterson is our CFO. He comes from oil and gas investment banking. So he is kind of coming to the company to help us prepare our books, clean them up and make them really standardized for acquisition moving forward. He's done a great job since he's been here. Nathan Myers is kind of a unique piece to King. He actually is in-house counsel. You very rarely find independent operators that have in-house counsel. Nathan is one of the 300 board certified oil and gas attorneys in the state of Texas, and he actually shut down his private practice in order to work with us a little over a year ago. And it is a tremendous advantage and benefit to be able to have someone of his caliber working within our walls each day. Then there's me. I'm in charge of markets and growth. So I do a lot of I manage the capital raise and a lot of our investor relations systems and protocols and training and things like that, just to make the experience for investors as simple and transparent as possible. Rex Gifford is our EVP of Tax and Accounting Advisory. Rex was our CFO for 15 years here and 15 years at another oil and gas company previous, and he started his career taxing oil and gas companies for the IRS. You will not find a stronger wealth of knowledge anywhere in this space when it comes to oil and gas and taxation. And Rex works on a lot of our product development, fund development, design, and he works directly with you and your CPAs around tax season so that your CPAs have an expert they can lean on to use the K1 properly. Michael Tanner is our Director of Finance and Analytics. He is, to summarize his job, he's the one in charge of making sure if we want to drill a well, that if we drill it, it'll be economic. So Michael has joined us here from the School of Mines in Colorado. Just a really sharp young guy, really on top of everything, great energy. Big fan of Michael. Paul Jerome is our head of geoscience. Between he and Kelly Duncan, who's our head of operations and drilling, they have worked together for years in the industry. They've drilled about 1,800 wells everywhere from America to the Middle East. There's really not much they haven't seen. And it's really awesome to watch them work together since Kelly rejoined us. And then John Malden is our chief economist. Many of you may know him. He is a well-known author and macroeconomist, and he's got about 1 million people on his newsletter that follow his every Saturday. He posts an economic overview or outlook. It's been great to have John working with us here to help us, navigate the waters of the world while we're drilling oil. We have a very simple process. If this is something you're interested in, obviously reach out to us and we'll walk you through any education you need on the plan. I will note that our geoscientist or geologist actually wanted to be quoted on our pay zones in Borden County. He said, in analyzing the downhole electric logs, I've never seen this many potential pay zones. We have a really good piece of property that's pretty raw. So we have a lot of development work to do, but the upside looks great. So all you'd have to do is, if something you want to do, just decide how many units you want to purchase. We'll send you a DocuSign, you sign it, send in a wire, you get your tax write-off, and you start collecting your income about 60 days later. And the interesting thing about us with our tax write-off is it's given, it's not earned. So in real estate, you don't have to be a real estate professional or show you did any work. You just simply have to send a wire and sign a document. So a little bit about our track record. I think it's always important to walk through this. So until 2015, we did business like everyone else. Small wellbore assignment deals where essentially our investors got a tax write-off in income while we profited on the lease. We decided to, our CEO actually wrote a book on that, which we can certainly send you a PDF copy to read. But he decided in 2015 that we should swap the model and be able to essentially offer our clients a better mix, an asset-backed security in the oil and gas space. So in 2015, we launched a beta program. We raised $4.5 million and we ended up selling the property for $13.5 million in 19 months. It was a phenomenal test run in the marketplace. And then our second program we started began in Larimer County, which I just walked through. Political challenges, the COVID pandemic, many different things. So instead of closing down the fund, which is essentially unoperatable until after COVID, we actually grandfathered it into a new program with us, and we surrounded it with properties that we purchased through COVID at a really great discount. And investors in program 3 actually saw a 19% ROI last year if they were invested from January to December. We closed the fund out in August, which is a pretty big month for us. And then we saw, so I'm going to answer some of your questions right now, which is, what is a worst case scenario for a fund? And we actually experienced that, in my opinion, last year. So in June of 2022, we started seeing inflation really hit hard in the oil and gas industry. By September, the cost of drilling had actually accelerated and was now 35% more expensive. So a $10 million horizontal well now costs $13.5 million, really chewed into profits. And at the exact same time, we saw the price of oil drop from 120 to 60 and natural gas from 9 to 2. Along with this, in a perfect storm, banks all around the country, for green energy purposes or whatever the reason was, they started freezing credit lines for oil and gas operators throughout America. This is a perfect storm, a horrible storm to go through, where your cost of making a product goes up 35%, and the price being sold in the marketplace went down 60 and 80% at the same time that you didn't have access to debt. So while this was happening in early summer, late spring of 2023, we were looking for another property for this program, and we decided the best thing we could do was save money on new land acquisition and apply it towards development. So we acquired program 3, which offered immediate revenue to our program 3 investors who were still waiting for some of our Borden County wells to come online. So it added a really good mix in the process. I feel like it was good stewardship for us to be able to do that and bring program 3 along with program 4. Both add value to one another, and it increased the asset size of the fund pretty significantly. So in the end, it was a pretty good move by us. Now, what I have here for the last couple slides, these are just breakdowns. So these are broker-dealer eligible full breakdowns financially of program 1 and program 3 of our monthly income, our divestitures, some of our locations, some of our coordinates of wells. So I'll be happy to share that with you, but it's not something I do generally during presentations. It's something you could review or speak with one of our SVPs about as well. But that's what I have for you here today. So I wanted to go ahead and wrap this up and go ahead and get to Q&A if we can.
Great. Thanks for all the information. We do have one question coming in to start, but again, I really emphasize use the chat and Q&A function. Anybody who has any questions, because now's the time. But to kick things off, we do have a question. What is your minimum investment? Also, considering the current price is $70, how will you achieve the 3.5 multiple?
Well, we have 3 to 5 years. So the price of oil fluctuates on a regular basis. You can go back to the Obama administration, where oil was consistently over $100 per barrel. Just about every analyst on Wall Street is predicting 3-digit oil next year. So we don't really sweat the current price of oil. It was at 88 a couple of weeks ago. So it fluctuates quite a bit and creates volatility. I will state our minimum investment's $100,000, but we are really focused in on production. So the more you produce, the less price impacts you. It's kind of the margin versus volume game. So while it does impact us now as we're building up the fund, pretty significantly some months, in general, the price of oil and gas, especially natural gas, they are volatile. So you will get a couple of months at really high pricing, a couple of months at lower pricing, but ultimately you see it ratchet up over time. And to be quite frank with you, there are a lot of misinformation, disinformation campaigns that are happening, and they're not being sent out by people on Twitter. They're being sent out by governments right now. It's really difficult to gauge what the actual supply is. The one thing we do know for certain is that demand is increasing. Despite what the news tells you, it's very verifiable to see that we need to go from 103 million barrels per day of production to 110 by 2028 and 140 by 2035. So the demand model is there. There's a lot of gray area in supply that's out there with Russia and OPEC Plus doing what they're doing right now. Very good question.
Great. Thank you for the answer. Thanks for the question to the attendee that asked that. Do we have any other questions for Eric or Charles while we have their time? If not, did you have a slide or contact information that you had up there that you don't want to reference for the individuals that are may be watching the recording in the future, or that the questions may not be jogged in their memory at the moment?
I do not have a slide for contact. Normally we do these things and we don't put that up there. But you can certainly reach out to us at kingoperating.com. So KINGOPERATING.com. And just let them know that you came to the Camo Plan webinar, and we will get you in touch with Cole Oliver immediately.
Oh, great.
Yeah. It's funny, Eric, you mentioned BlackRock and how they're pushing all this green energy and whatnot. There's actually an article that just came out this week that I was reading that they've really backed off of that because they're losing money hand over fist in that fund. So I just wanted to mention that they're backing off that as well. And as you mentioned, the demand for oil is just going up. And as we know, this administration has been trying to slow things down in the States while buying offshore, while also using all of our strategic reserves. So price of oil is certainly not going down anytime soon.
Well, the interesting thing is when the Nord Stream 1 and 2 blew up, I came into the office and everyone goes, "Who did it?" And I said, "Probably us." That was the logic. And then I said, well, what they're going to do is they're going to use that to drive the prices up in Europe. They're going to keep the prices down here in America. They're going to sell them to Europe and claim it on the GDP, which is exactly what they did before the midterm elections. It's not a conspiracy theory. You can see it in our GDP report. Same thing's kind of happening with oil right now. Earlier this week, they announced that oil is now the #1 export of America. Can you imagine that? We use 18.6 million barrels per day. There's 2 to 3 rigs coming off of the market because prices aren't good every week. There is no supply, despite the fact that our government boards keep telling us we have tons of supply. That's why we're exporting. Our SPR should be being refilled right now, but we're actually selling to foreign countries and now allowing Venezuela to invade Guyana to steal their oil so that we can get it cheaper. It's a big mess out there. Everything's a mess. But if you really want to look at portfolios and where you should be going, look at BlackRock. Largest portfolio manager in the world, largest asset manager in the world. ESG investments over the last 20 years, 10 trillion from private investors, 10 trillion from governments have gone into green energy and has reduced oil and gas demand or usage by 2.14%. Has done nothing. It's a huge waste of money. So as their green energy investments fall off the cliff, as the stock market next year will definitely fall off the cliff, that's my prediction. I'm sticking to it. As that happens, what is BlackRock doing? They're buying oil and gas and trying to launch a Bitcoin ETF. If you want to know where to put your money, those are 2 places to start, because they're going to need some way of levering up the losses that are on the way. And they're way ahead of us as far as information. So I kind of watch what they do and follow suit and try to understand why they're doing what they do. They're going into oil and Bitcoin. Those are the 2 areas they're going into.
Mm-hmm. Yep. Yeah, they already scooped up all the real estate, so.
Yeah.
Awesome, Eric. Well, I appreciate your time, and Camo Plan, we appreciate you having us on as well. It doesn't look like we have any more questions, so thank you very much for everybody that's joined.
Absolutely. Thank you, guys. Appreciate it.
Thank you. Have a great rest of the day. Bye.
You too.